Okay, welcome back. I've left some of the video from the previous teaching on so I can pick up and continue where we left off. And what we looked at in the last video, we looked at accrued expenses. And I looked at the example of my construction company, Steve's Construction Company. And Steve's Construction Company is in an agreement with you where you have agreed to pay us. Let me move this around a little bit. I think I have it now. Okay, Steve's Construction Company. So you've agreed to pay us $1,000 a week. Per week is what you're going to pay us. And we had a situation where we are in between time periods here. We have time period 1, time period 2. And I broke down time period 1 and time period 2 to say in between there's a week, Monday, Tuesday, Wednesday, Thursday, Friday. And we're going to pay John on Friday for wages that are paid over a week period of time, and that week happens to fall right between two time periods, time period 1 and time period 2. And the adjusting entry that we need to make is to recognize that we incurred expenses right here, Monday, Tuesday, and Wednesday. We incurred expenses of $100 a day to our friend John, and I agreed to pay him. I have to recognize those expenses when they are incurred in time period 1, even though they get paid in time period 2. And the entry to record those expenses, the third adjusting entry of accrued expenses, the third entry here is where we debit wages expense for $300, credit wages payable for $300 in time period 1. Over in time period 2, when we actually pay them, we debit wages expense for $200 Thursday and Friday at $100 a day. We debit wages payable for $300, eliminating our liability from time period 1. And we actually pay John $500. Now the question is, what about accrued revenues? What about accrued revenues? Because we still, on our books, not only have we incurred expenses to John that we need to pay him, but we have also earned revenue, right? We have earned revenue. And we've earned revenue for 3 days worth of work. I'm paying John at $100 a day, but you've agreed to pay me $1,000 a week, so you're actually paying me $200 a day. So in the same spirit that I have to pay John and recognize the expenses to John, I also have to recognize the revenue that you owe me. And can you see it's $200 a day? I'm going to just show our diagram over here. You're going to owe me time period 1, time period 2, or for a Monday, Tuesday, Wednesday, Thursday, Friday. You're going to owe me $200 a day, and $200 a day, and $200 a day, and $200 a day, and $200 a day. And so at this point in time, I need to recognize this revenue for $200 a day that you owe me. So not only am I recognizing the expenses, the accrued expenses, but I'm also going to recognize the accrued revenue. Now here's the question. What's the entry going to look like? What is the adjusting entry going to look like to record the revenue? Well, you owe me how much? $200, $400, $600. You owe me $600. So, and I'm recognizing revenue. So I'm going to call this revenue earned. Revenue earned, or revenue or income, how you want to think of it. It's earned revenue. It's a revenue account. How much? $600. What's the debit? The debit is to accounts receivable. You owe me $600 because we have performed $600 worth of services for you, 3 days at $200 a day. So I have a receivable from you for $600, and I have accrued, or I have revenue earned. This is not accrued revenue. This is income earned of $600. This is going to show on the income statement, $600. This is going to show on the balance sheet. Assets equals liabilities plus owner's equity. Owner's equity is influenced how? Revenues minus expenses. the $600 is going to show up. This $600 is going to show up in revenue. This $600 here in accounts receivable is going to show up as an asset. Put a little 1 there and a 1 here. There's an accounting trick to show that those ones go together. That $600 is an asset. This $600 is revenue, and revenues minus expenses equals net income. So my net income is going to go up by $600, which means owner's equity is going to go up by $600. My assets went up by $600. My accounting equation is good. It's not violated. Everything's still in balance. So this is the entry to record the adjustment. See, if I did not make this entry, I would be understating my revenue by $600, and I would be understating my assets by $600. But because I'm recording, my accounting information system is an information reporting system, right? Accounting is an information system that's used to identify, record, and report relevant business transactions. This is a relevant business transaction because it's reporting my books in accordance with generally accepted accounting principles. So I have a receivable of $600 and I have income that I've earned of $600 here. Now you don't pay me until the following period. And when you go to pay me in time period 2, what is that entry going to look like? It's going to look like this. You're going to pay me cash of how much? $1,000. That's what you pay me every week. But I haven't earned all of that cash in time period 2, right? I've earned how much? I have revenue earned. In time period 2, how much have I earned? Only 2 days now at $200 a day, so I have $400 of revenue that I've earned. And I'm still off $600 because debits have to equal credits. What is that $600 that now gets credited? It's this liability over here. It's the accounts receivable that I recorded is now collected. So I'm going to credit accounts receivable for $600. See how this works? The receivable that I showed at the end of time period 1 for $600 is now gone because you've paid it. I've received $1,000 in cash, which is what you pay me, and of that $1,000, only $400 is actually revenue that is earned in time period 2. That's the important part. We're accruing the revenue. It's revenue that we've earned in time period 1 that's not paid until time period 2. We have to record it in time period 1 and show it as a receivable. And then over here, when we collect the receivable, we debit cash. That's how much you pay us. We credit the receivable $600. We credit the revenue earned for $400. In time period 1, how much revenue did we earn? The answer is $600. In time period 2, how much revenue did we earn? The answer is $400. So we split the $1,000 that you're paying us into its appropriate time periods. So hopefully this will make sense. This is the opposite side of the accrued expenses. This is, well, it's not the opposite side. It goes along with the accrued expenses. It's the accrued revenue that we're picking up. So accrued revenue is from what? We said accrued expenses are costs that we incur in a time period, but they're not paid and they're not recorded. Well, what are accrued revenues? They're revenues that we've earned in a time period, but they're not recorded and they're not yet received. That's what we have here, right? It's not recorded and it's not yet received. So that's what we're looking at here. This $600 was not recorded and it wasn't received. So we show it. We do record it, even though it gets received later on. So accrued expenses and accrued revenues are the last two of our adjusting entries that we will record at the end of a time period. These will make sense the more you work with them, the more you see them, the more you kind of go back, look at these videos if you want to see the examples over and over again. That's one of the reasons why I want to put this on videos, because you guys can stop it and start it and stop it and start it and get a piece of scratch paper out and draw T accounts and see how everything's working and bring questions to class, that kind of stuff. But I'm trying to use the technology as a way of putting content and bringing content before you. So I think this is going to bring an end to our chapter 3. Actually, maybe not. I may do one more video just to show something like how depreciation expense gets recorded, because they show that in the book. So I will do another video on that. So we'll see you in the next video.